Welcome back to the deep dive. So if you're looking at the Bitcoin price just soaring, but then, you switch tabs and see headlines about the economy shrinking and political chaos, well, you're probably feeling a bit of whiplash.
Yeah, that feeling. That's pretty much exactly the critical point the market's at right now. It's why this deep dive today is so important, I think. We're seeing this fundamental split happening.
A split how?
Well, you've got this really strong internal crypto momentum, Bitcoin hitting 7-week highs, right?
Yeah.
But it's happening against, frankly, a rapidly worsening external macro situation.
Okay, so that's the mission today then. We need to unpack the data, look at Bitcoin's internal strength, and then really dig into this tension. It feels like this is the question for the rest of Q4 2025.
Definitely. Can this internal demand, this adoption, keep pushing forward, even with all these big systemic macro risks looming?
Because the thing that grabbed everyone the hook was Bitcoin surging yesterday to, $119,450? A huge technical win.
Yeah.
But that happened on the same day we got news the U.S. labor market actually contracted sharply and unexpectedly.
It's the ultimate push-pull, isn't it? We really have to break down both sides. Okay, let's get into it.
Right. Let's start with the engine here. The price action itself and the spot demand driving it. Yesterday's move, it felt pretty definitive, technically speaking.
It was. Bitcoin jumped about 4%, hit that 7-week high, $119,450 on Coinbase, and closed strong around $118,796.
And technically that's important because...
Well, it didn't just inch higher. It broke cleanly through a really key resistance zone, that $117,500 to $117,700 area that had been holding things back for weeks.
Ah, okay.
So for the chart watchers, breaking resistance like that and holding above it, that potentially turns the old ceiling into a new floor. It's textbook bullish continuation.
Okay, but let's not get ahead of ourselves. Our sources are flashing a pretty big warning sign here too, aren't they?
They are. Technical analysts are already throwing some cold water on it, saying this rally might be, and I quote, running on fumes and FOMO.
Fumes and FOMO. Right. Yeah. So there's a real risk it could fizzle out.
Absolutely. And the technical warning is clear. If Bitcoin can't hold the critical support level around $108,000 in the next few days, that could signal a fast reversal.
How fast?
Potentially quite fast. If that 108K support breaks, the consensus is we could see a pretty sharp, significant drop towards the $80,000 zone.
Wow.
Yeah,
right.
And given the leverage in the system, which we'll get to, that downside risk, you just can't ignore it.
Okay, so if the technicals are maybe a bit shaky, why are some people saying this rally feels different? What's underneath it?
Well, this is what's really interesting. It doesn't seem to be just technical chart patterns or, a short squeeze. It looks like it's validated by genuine, fundamental spot demand.
People actually buying Bitcoin, not just derivatives.
Exactly. Real appetite for the actual coins.
Yeah.
The data we're seeing shows monthly spot demand has climbed by over 62,000 Bitcoin since July.
62,000 BTC bought up since July. That's a massive amount being absorbed from the market.
It really is. And that sustained buying pushed the price past a really important psychological and on-chain level. The traders' realized price.
Okay, remind us what that is.
It's basically the average price at which short-term holders, the traders, bought their coins. That was around $116,000. So breaking above that means, on average, those recent buyers are now back in profit.
Ah, less selling pressure then.
Potentially, yeah. It signals maybe a structural shift back towards a bull phase, driven by people actually accumulating.
And what about the money waiting to jump in? We often look at stablecoins for that, right? The stablecoin supply ratio, SSR?
Exactly. The SSR compares the supply of stablecoins to Bitcoin's market cap. Think of stablecoins as the cash on the sidelines in the crypto world.
So a low SSR means the cash has been spent on Bitcoin.
Right. But right now, the SSR is actually pretty high, which is typically seen as a buy signal. It suggests there's a lot of stablecoin liquidity, dry powder, ready and waiting to be deployed.
Interesting. And who's holding with conviction? The long-term players.
That's another key piece. The long-term holders, or LTHs, wallets, defined as accumulation, addresses the ones that mostly just buy and rarely sell.
Yeah.
They're now holding over 298,000 BTC.
Nearly 300,000 Bitcoin locked away by strong hands.
Immense conviction. These folks are pulling significant supply off the market. It suggests they see any macro-induced dips not as a reason to panic, but maybe as a buying opportunity.
So you combine that spot demand, the waiting liquidity, the long-term holders. What's the outlook then?
Well, based on all that, some analysts are putting out some pretty aggressive Q4 price targets. We're talking maybe $160,000 to $200,000.
Wow. Okay. That's ambitious.
It is, but it's rooted in those supply and demand dynamics we just talked about.
Okay, now let's flip the coin. The derivatives market, this is where things get amplified, right? And volatile. That internal strength seems to be getting turbocharged by a lot of leverage.
That's right. Aggregate open interest. That's the total value of all outstanding futures and options contracts. It's climbed back up to around $42 billion.
$42 billion. How close is that to the peak?
It's just shy of the recent peak. So, yeah, it signals a highly leveraged environment. A lot of speculative money is in the game right now.
And we can see that bullish speculation in the funding rates, too. They're high.
Exactly. Funding rates are elevated. That means traders going long, betting on the price going up, are dominant, and they're willing to pay a premium to those betting short just to keep their positions open.
So lots of bullish enthusiasm, but also risks.
Big risk concentration, yeah.
Yeah.
Now, what's different maybe this cycle is that this high leverage environment is happening alongside much more mature institutional participation.
Right. You mentioned the CME group data.
Yeah, the CME, the big regulated U.S. futures exchange, reported record crypto average daily volume in Q3. 340,000 contracts a day on average.
So big regulated players are definitely involved now.
They are. The market structure is more mature in that sense. But tactically, it's still incredibly volatile. That $42 billion in open interest means the market's walking a tightrope, meaning any significant price drop, especially one triggered by bad macro news from outside crypto, could set off a rapid deleveraging, a cascade of liquidations that wipes out gains very, very quickly.
So mature participation, but still fragile to shocks.
Precisely. Mature, but poached precariously.
Which brings us neatly to those external headwinds, the macro picture. And it doesn't look great, does it?
No, it really doesn't. That old Wall Street saying bad news is good news because it means the Fed might cut rates. That might be breaking down. We're seeing data pointing towards, well, potentially stagflation.
Stagflation, slow growth, and high inflation, the worst combo.
Exactly. Look at yesterday's ADP private payrolls report. It showed a net cut of 32,000 jobs in September. Expectations were for, modest growth. That's a big miss and a sharp reversal.
And it wasn't just jobs, right? Manufacturing data, too.
Correct. The ISM manufacturing PMI stayed in contraction below 50 for the 7th month straight. It came in at 49.1. The comments in the survey mentioned severely depressed conditions, slowing orders. It's not a pretty picture.
And throwing fuel on that fire is the political situation the government shut down.
Right. Which creates this immediate operational problem, but also an information problem. A data drought, as some are calling it.
How so?
Well, key government stats, like the big official Bureau of Labor Statistics jobs report everyone watches, they're delayed. Policymakers, investors, we're flying blind to some extent.
And the White House is warning about layoffs.
Yeah, warning of imminent mass layoffs of federal workers. So this administrative gridlock could quickly become a real economic hit.
Okay, so we have Bitcoin rallying on strong internal demand while the wider economy is flashing stagflation warnings and Washington is paralyzed. How do these two worlds connect?
Well, this is where a potentially powerful new narrative emerges. The idea that Bitcoin is actually being bought because of this mess. As a hedge.
A hedge against what specifically?
Against economic uncertainty, sure, but maybe more pointedly, against policy paralysis, like the Fed being trapped, unable to act decisively with conflicting signals on jobs and inflation, and also a hedge against this data blindness.
Interesting. So when official data becomes unreliable...
Bitcoin's transparent, 24/7 globally accessible ledger data starts to look pretty appealing as a source of objective truth, especially maybe for institutional players.
Okay, let's talk regulation then. Because despite the shutdown freezing some things, there's actually some really important long-term progress, wasn't there?
Yes, absolutely. Critical clarification came from the SEC regarding custody. They issued a no-action letter.
And what does that mean in plain English?
It basically clarifies that registered funds and RIAs, registered investment advisors, think wealth managers, they can use state-chartered trust companies as qualified custodians for digital assets under certain conditions.
Okay, sounds technical, but why is that a big deal for money flowing in?
It's huge because it removes a major compliance roadblock. Big institutions like pension funds, endowments, they have very strict rules, fiduciary duties about where they can hold assets. This SEC letter gives them a compliant pathway for digital assets using these trusted state-chartered firms.
So it opens the door for potentially billions or trillions in institutional capital that was previously stuck on the sidelines due to regulatory uncertainty.
Over time, yes. It greases the wheels significantly. It's
Hmm.
one less major legal barrier for those big pools of capital.
And speaking of influence in D.C., there was that interesting story about the CFTC nomination.
Ah, yes, the Brian Quinten's nomination withdrawal. It's quite telling. The White House pulled back his nomination to be a CFTC commissioner
After.
after prominent crypto industry leaders, people like the Winklevoss twins, apparently raised concerns directly with the administration.
What were the concerns?
That he wasn't maybe sufficiently pro-innovation or aligned with making the U.S. a leader in this space. The signal here is pretty strong.
That the industry isn't just reacting anymore, they're actively trying to shape who the regulators are.
Exactly. They've moved from being rule takers to having a seat at the table, influencing appointments. It shows a new level of political maturity and influence for the crypto sector in Washington.
Okay, let's shift to Section 4 now. How are companies actually using crypto? It feels like we're moving beyond just holding Bitcoin as digital gold.
Definitely. We're seeing the emergence of what you could call digital asset alpha. Companies aren't just passively holding, they're developing active strategies to generate yield or use crypto for financing.
Moving from a store value play to a capital strategy play.
Precisely. And we have a couple of really good examples just from the recent news flow.
Okay, first one.
Financing arbitrage. Look at Juicy Holdings. They're listed on NASDAQ, ticker JZXN. They announced a private placement, basically selling new shares to raise up to $30 million.
Okay, fairly standard capital raise.
But here's the key part. The stated use of proceeds is specifically to purchase cryptocurrencies.
Wow. So they're raising dollars in the stock market to immediately buy crypto for their treasury.
Yes. They're essentially using the traditional equity market to fund their digital asset strategy. They see more upside or stability there than maybe in their core business operations or just holding cash. It's direct arbitrage.
Okay, that's fascinating. And the second example, using crypto to generate income.
Right, operational yield. We got an update from Satoshi Pay about their corporate treasury.
Mm.
Their Bitcoin and Ether holdings generated over 21,600 euro in realized yield just since late August.
Okay, how does that translate annually?
They calculated it equates to an average annualized APR of, get this, 18.76%.
18% yield on Bitcoin and Ether holdings.
Almost 19%, yeah. They're not just sitting on it, they're actively managing it, likely through staking, lending, or other DeFi strategies to generate significant income. They're acting like a small digital asset fund.
That really changes the game for how companies might view holding these assets. Okay, one more thing happening in the markets, this sudden rotation into privacy coins.
Yeah, that was quite a move in the last day or so.
Yeah.
Capital seemed to flow pretty rapidly into privacy-focused coins, and the leader was Zcash, ZEC.
How big a move was it?
Huge.
Okay.
Zcash surged somewhere between 64% and nearly 90%, hitting a 3-year high.
Okay, what's driving that all of a sudden?
Well, it seems like a mix of things coming together. On the tech side, they launched something called Zashi CrossPay, which allows shielded private transactions across different blockchains. Plus, it got integrated into ForSwap, boosting its usability.
Any institutional angles.
Definitely seems like it. There are reports Grayscale might be accumulating ZEC. And crucially, there's a lot of anticipation around an SEC decision on a proposed Zcash spot ETF from 21 shares. That decision is expected very soon, October 5th.
Ah, the ETF anticipation factor again. So, tech upgrades, better access, and potential institutional on-ramps driving the Zcash rally.
Seems to be the cocktail, yes. It shows capital is nimble and ready to rotate into established altcoins when there are clear catalysts.
Okay, so let's try and pull this all together, synthesize the state of play. It really feels defined by this split, this bifurcation you mentioned at the start.
I think that's exactly right. You have the internal crypto-native bull case looking really quite strong. Spot demand is there. We're getting crucial custody clarity. Corporations are getting smarter. But that external macro risk, it's not just there. It's arguably increasing. Stagflation is a real worry. And that high leverage we talked about makes the whole system very vulnerable to an external shock.
So investors are facing a really stark choice right now.
They really are. Do you prioritize the internal adoption story, the long-term structural bull case for crypto? Or do you focus more on the immediate fragility, the leverage setup, and the risk of a macro event knocking everything down, at least short-term?
The bull case versus the immediate bear risk.
Exactly. Though it's worth noting, for the long-term players, the ones with that conviction we saw in the LTH data, they might actually see price weakness caused by macro fears as a prime opportunity to accumulate more.
Because the underlying adoption trend is still intact for them.
Potentially, yes. The adoption curve keeps grinding higher, even if the wider economy hits a rough patch.
Okay, so let's recap the key takeaways for everyone. Bitcoin's hitting fresh multi-week highs, and it looks like it's backed by real spot buying and helped by improving institutional access, like those new custody rules.
Right, the internal picture looks pretty solid.
But it's happening in a highly leveraged market, making it susceptible to sudden drops. And all this is playing out against a backdrop of worsening economic data, potential stagflation, and political paralysis from the government shutdown, which is even obscuring some key economic data.
That sums up the tension perfectly. The internal engine versus the external storm clouds.
Okay, let's wrap with a final thought then. Something for you, our listener, to mull over.
Okay, here's something to think about. The U.S. government shutdown. It's completely stalled the operational review of things like new spot Bitcoin ETFs at the agency level, right? The gears are frozen.
Right, nothing's getting processed.
Yet, during this exact same period, we saw crypto industry leaders successfully exert enough influence to get a high-level White House nomination for the CFTC withdrawn. So here's the question. If the industry has now reached a point where it can effectively shape who its future regulators will be through political influence, does the temporary administrative freeze on processing paperwork even matter that much in the long run? Or has the real regulatory game already shifted decisively into the political arena, making these operational delays less significant than they seem? Something to ponder.